Okay, what's up, everybody? This is Sunko, the Korean Bro. Today is 2024, May 17, and let's see what articles we have tonight. After done reading articles, and I'm gonna go over to read it. Okay, let's see. Mollyfood.com. One magnificent dividend stock down 30% to buy and hold forever. What would that be? Enbridge stocks around 30% below its high in 2015 and off around 20% from its 2022 peak. The company continues to pay a dividend year in, year out, with the annual streak of increases now up to 29 years. Hmm. What does Enbridge do? Enbridge is not an exciting company, but that's really part of management's plan. It is designed to generate reliable and growing cash flows it can use to pay investors a reliable and growing dividend. With 29 years worth of annual dividend increases, the Canadian energy company has clearly lived up to the plan. However, the stock is still down materially from its highs, which income investors should probably view as a buying opportunity. So, Enbridge is a North American energy giant that is usually lumped into the midstream sector. That makes logical sense given that historically around 57% of its earnings before interest, taxes, depreciation, and amortization came from oil pipelines, with another 28% from natural gas pipelines. This sums up to roughly 85%, which is a very big number. The rest of the business have been broken down between a natural gas utility and renewable power investments. Hmm. Most of its assets, however, have similar revenue dynamics since they are either regulated, fee based, or contract driven. They always a toll taker to generate a reliable stream of cash flow, regardless of what oil and natural gas prices are doing. Hmm. Demand for NVIDIA's AI chip design is skyrocketing, and that should continue. Taiwan Semiconductor builds products for NVIDIA and hundreds of other companies. OpenAI's primary tech partner is bringing the benefits of AI to millions of users. Hmm. Okay, why don't we just go over to the book and read it? Okay, starting from page number 84. Hmm. Okay. The higher they go, the harder they fall. As the enduring antidote to this kind of bull market bounty, Graham urges the intelligent investor to ask some simple, skeptical questions. Why should the future returns of stocks always be the same as their past returns? When every investor comes to believe that stocks are guaranteed to make money in the long run, won't the market end up being wildly overpriced? And once it happens, how can future returns possibly be high? Graham's answers, as always, are rooted in logic and common sense. The value of any investment is and always must be a function of the price you pay for it. By late 1990s, inflation was withering away. Corporate profits appeared to be booming, and most of the world was at peace. But that did not mean, nor could it ever mean, that stocks were worth buying at any price. Since the profits that companies can earn are finite, the price that investors should be willing to pay for stocks must also be finite. Think of it this way: Michael Jordan may well have been the greatest basketball player of all time, and he pulled fans into Chicago Stadium like a giant electromagnet. The Chicago Bulls got a bargain uh, by paying Jordan up to $34 million a year to bounce a big letter ball around a wooden floor. But that does not mean the Bulls would have been justified paying him $340 million and or $3.4 billion or $34 billion per season. Limits of optimism. Hmm. Focusing on the market's recent returns when they have been rosy, warns Graham will lead to a quite illogical and dangerous conclusion that equally marvelous results could be expected for common stocks in the future. From 1995 through 1999, as the market rose by at least 20% each year, a surge unprecedented in American history, stock buyers became ever more optimistic. In mid 1998, investors surveyed by the Gallup Organization for the Payne Weber brokerage firm expected their portfolios to earn an average of roughly 13% over the year to come. By early 2000, their average expected return had jumped more than 18%. So, sophisticated professionals were just as bullish, jacking up their own assumptions of future returns. In 2001, for instance, SBC Communications raised the projected return on its pension plan from 8.5% to 9.5%. By 2002, the average assumed rate of return on the pension plans of companies in the Standard& and Poor's 500 stock index has fallen to record high 9.2%. A quick follow-up shows the awful aftermath of access enthusiasm. Gallup found in 2001 and 2002 that the average expectation of one-year returns on stocks has slumped to 7%, even though investors could now buy at prices nearly 50% lower than in 2000. Those gung-ho assumptions about the returns on their pension plans will cost these companies in the S&P 500 a bare minimum of $32 billion between 2002 and 2004, according to recent Wall Street estimates. Even though investors all know they're supposed to buy low and sell high, in practice they often end up getting it backwards. Graham's warning in this chapter is simple: by the rule of opposites. The more enthusiastic investors become about the stock market in the long run, the more certain they are to be proved wrong in the short run. On March 2000, the total value of the US stock market peaked at $14.75 trillion. By October 9, 2002, just 30 months later, the total US stock market was worth $7.34 trillion, or 50.2% less, a loss of $7.41 trillion. Meanwhile, many market pundits turned sourly bearish, predicting flat or even negative market returns for years, even decades to come. At this point, Graham would ask one simple question: considering how calamitously wrong the experts were the last time they agreed on some, why on earth should the intelligent investor believe them now? So what's next? Instead, let's tune out the noise and think about the future returns as Graham might. The stock market's performance depends on three factors: real growth, the rise of companies in earnings and dividends; inflationary growth, the general rise of prices throughout the economy; speculative growth or decline, any increases or decreases in the investing public's appetite for stocks. So in the long run, the yearly growth in corporate earnings per share have averaged 1.5% to 2%. As of early 2003, inflation was running around 2.4% annually. The dividend yield on stocks was 1.9%. So in the long run, that means you can reasonably expect stocks to average roughly a 6% return. If the investing public gets greedy again and sends stocks back into orbit, then that speculative fever will temporarily drive returns higher. If instead investors are full of fear, as they were in the 1930s and 1970s, the returns on stocks will go temporarily lower. Robert Schiller, a finance professor at Yale University, says Graham inspired his valuation approach. Schiller compares the current price of the Standard& and Poor's 500 stock index against average corporate profits over the past 10 years. But scanning the historical record, Schiller has shown that when his ratio goes well above 20, the market usually delivers poor returns afterward. When it drops below 10, stocks typically produce handsome gains down the road. In early 2003, by Schiller's math, stocks were priced at about 22.8 times the average inflation adjusted earnings of the past decade. Still in the danger zone, but way down from their demented level of 44.2 times earnings in December 1999. How has the market done in the past when it was priced around today's levels? Figure 3.1 shows the previous periods when stocks were at similar highs. How they fared over the 10 years sketches followed. So, from a valuation level similar to those early 2003, the stock market has sometimes done very well in the ensuing 10 years, sometimes poorly, and muddled along the rest of the time. I think Graham, ever the conservative, will split the difference between the lowest and highest past returns um, and project that over the next decade stocks will earn roughly 6% annually or 4% after inflation. Interestingly, the projection matches the estimate we got earlier when we added together real growth, inflationary growth, and speculative growth. Compared to the 1990s, 6% is a chicken feed, mm, but it's a whisker better than the gains that bonds are likely to produce. Reason enough for many investors to hang on to stocks as part of a diversified portfolio. But there is a second lesson in Graham's approach. The only thing you can be confident of while forecasting future stock returns is that it probably turn out to be wrong. Hmm. The only indisputable truth that the past that teaches us is that the future will always surprise us, always. And the corollary to that law of financial history is that the markets will most brutally surprise the very people who are most certain that their views about the future are right. Staying humble about your forecasting powers, as Graham did, will keep you from risking too much on a view of the future that may well turn out to be wrong. So, by all means, you should lower your expectations, but take care not to depress your spirit. For an intelligent investor, hope always springs eternal because it should. In the financial markets, the worse the future looks, the better it usually turns out to be. Hmm. A cynic once told G.K. Chesterton, the British novelist and essayist, "Blessed is who expect nothing, for he shall not be disappointed." Child's rejoinder, "Blessed is he who expected nothing, for he shall enjoy everything." Okay, nice comment. General portfolio policy. The defensive investor. The basic characteristics of an investment portfolio are usually determined by the position and characteristics of the owner or owners. At one extreme, we have had saving banks, life insurance companies, and so called legal trust funds. A generation ago, their investments were limited by law in many states to high grade bonds and, in some cases, high grade preferred stocks. At the other extreme, we have the well to do and experienced businessman who will include any kind of bond or stock in his security list, provided he considers it an attractive purchase. Mm. It has been an old and sound principle that those who cannot afford to take risks should be content with a relatively low return on their invested funds. From this, There has developed a general notion that the rate of return which the investor should aim for is more or less proportionate to the degree of risk he's already to run. Our view is different. The rate of return sought should be dependent rather on the amount of intelligent effort that investor is willing and able to bring to bear on his task. The minimum return goes to our passive investor who wants both safety and freedom from a concern. The maximum return would be realized by the alert and enterprising investor who exercise maximum intelligence skill. In 1965, we added, in many cases, there may be less real risk associated with buying a bargain issue, offering the chance of a large profit, than with a conventional bond purchase yielding about the four and a half. The statement had more truth in it than we ourselves suspected, since in subsequent years, even the best long term bonds lost a substantial part of their market value because of the rise in interest rates. The basic problem of bond stock allocation. We've already outlined in briefest form the portfolio policy of a defensive investor. You should divide these funds between high grade bonds and high grade common stocks. We've suggested as a fundamental guiding rule that the investor should never have less than 25% or more than 75% of his funds in common stocks, with a consequent average range of between 75% and 25% in bonds. There's an implication here that the standard and division should be an equal one, or 50-50, between the two major investment mediums. According to tradition, the sound reason for increasing the percentage in common stocks will be the appearance of the bargain price levels created in a protracted bear market. Conversely, sound procedure would call for reducing the common stock component below 50% when the judgment of the investor the market level has become dangerously high. We've had the great advances and collapses of the past, and this writer believes we are likely to have them in the future. If the division between investment and speculative operations were as clear now as once it was, we might be able to envisage investors as a shrewd, experienced group who sell out to the heedless, hapless speculators at high prices and buy back from at depressed levels. This picture may have had some verisimilitude in bygone days, but it's hard to identify it with a financial development since 1949. There's also no indication that such professional operations as those of the mutual funds have been conducted in this fashion. The percentage of the portfolio held in equities by the two major types of bond funds, balanced and common stock, has changed very little from a year to year. Their selling activities have been largely related to endeavors to switch from less to more promising holdings. Okay, we can urge that in general, the investor should not have more than one half in equities unless he has strong confidence in the soundness of his stock's position. Ensure that he could view a market decline of the 1969 and 70 type with equanimity. It is hard for us to see how such strong confidence can be justified at the levels existing in early 1972. Thus, we would counsel against greater than 50% apportionment to common stocks at this time, but for complementary reasons, it's almost equally difficult to advise reduction of the figure well below 50%, unless the investor is disquieted in his own mind about the current market level and will be satisfied also to limit his participation in any further rise to say 25% of his total funds. Conversely, a fall in the common stock proportion to 45% will call for the use of 1/11th of the bond fund to buy additional equities. Yale University followed a somewhat similar plan for a number of years after 1937, but it was geared around 35% normal holding in common stocks. In the early 1950s, however, Yale seems to have given up its once famous formula. In 1969, held 61% of its portfolio in equities. He's at least making some moves in response to market developments. Most important of all, will restrain him from being drawn more and more heavily into common stocks as the market rises to more and more dangerous heights. Furthermore, a truly conservative investor will be satisfied with the gains shown on half his portfolio in a rising market, while in a severe decline, he may derive much solace from reflecting how much better off he is than many of his more venturesome friends. While our proposed 50-50 division is undoubtedly the simplest all-purpose program devisable, it may turn out to be the best in terms of results achieved. Of course, no approach, mechanical or otherwise, can be advanced with any assurance that it will work out better than another. The much larger income return now offered by good bonds than by represented stock is a potent argument for favoring the bond component. The bond component, the choice of issue in the bond component of the investor's portfolio would turn about too many questions. Should he buy taxable or tax-free bonds? And should he buy shorter or long-term maturities? The tax decision should be mainly a matter of arithmetic, turning on the difference in yields as compared with the investor's tax bracket. Okay, this is it. This is it for today. It's getting a bit complicated, but I'll try my best to read it till the end. Yeah. Anyway, this is it, and I'll see you tomorrow. Okay. Bye bye. Good night.